and welcome to today's webinar. We have got a jam-packed morning ahead for you today and some really exciting news about our forthcoming launch of our INN8 Invest DFM proposition. But before we get going with that, there's a little bit of housekeeping I have to cover. The first thing is about CPD points. So CPD has been applied for, but to make sure you're eligible, please do make sure you stay for the entire webinar this morning. My tech team have also told me that we are due for some load shedding, but they have absolutely assured me that we won't know any difference. However, if there is any kind of break in transmission, please do stay with us. We'll be back very shortly. And finally, this is, as always with INN8 webinars, an interactive session. So please do put your questions in the Q&A and we'll get to them at the end. So with me today are two great speakers, Silke, Leigh Kohler. Thank you, and thank you for coming today. Daniel is, he's so well known in our industry. He's recognized as one of South Africa's leading political economy analysts. His success lies in blending both economic and political trends in highly accessible, yet insightful physical and virtual presentations. Welcome. And then Leigh Kohler. Leigh is joining us as our head of DFM. Leigh transforms the complexities of investing into easy-to-understand insights. He always says if his grandparents understand, then he's achieved his goal of bringing the investment world to everyone. Welcome, Leigh. Unfortunately, as Bill Wasim was supposed to be with us, but unfortunately he's not able to join us today. But I know he'll be watching from home, so hi, Wasim. I'm sorry you can't be here today. It's so great to be face-to-face, isn't it, after so many virtual webinars. And it's really great just to have that human interaction, particularly for such a momentous event as launching the INN8 Invest proposition to our wealth managers of the future. And I think back to 2017 when we launched INN8, first with our offshore platform, and then later on with our local platform. And we really were in a greenfield site, which quite frankly was pretty daunting. But I'm now so proud to be part of a brand, bringing yet another investment proposition to the wealth manager of the future, and having the INN8 Invest team under the INN8 umbrella. INN8 is inspired by you, the advisor, and through partnerships with you, we now have a purpose-built platform delivering technological expertise and execution capabilities, making your life easier. But we knew when we launched it, this was just the first piece in the jigsaw puzzle in providing solutions to our advisors. It's great to be here today with Leigh, delivering that next piece of the puzzle. Before we unpack the DFM proposition, though, which takes us further towards our vision of changing the way investments are done, we thought it'd be useful to understand the world in which our advisors find themselves in, trying to manage their clients towards their goals and dreams. Daniel, you're going to be sharing with us today an assessment of both the local and global geopolitical landscape and how it may affect economic growth and investment returns. Thank you. Over to you, Daniel.
Well, thank you very, very much, INN8, and what a pleasure it is for me to be with you this morning. It's a rough and tough environment, I think, for all of us, whether we are clients, whether we are investors, whether we are advisors for that matter. And I hope at least over the next 30 minutes or so to give you some insights to try and put the pieces of the puzzle together, because frankly, those pieces have become more fragmented and yet more interlinked as well. Now, what a remarkable 24 months it has been for all of us, whether it's in our business life or whether it's in our personal life. We have survived. I say survive because we're still going through it and it's not over yet, a once-in-a-lifetime pandemic. A pandemic that has taken tens of thousands of lives, but has also produced a vaccine. The remarkable advances of medical science certainly have helped us at least hopefully move now from pandemic to an endemic disease. But it's not just that. Just go back a year ago. Threats to democracy in the United States now make us question this particular issue like we have never done before. The American withdrawal from Afghanistan less than a year ago, not in a very, very glamorous fashion, I might add, has also led to question marks about the commitment of the United States to global security and perhaps was a forerunner to what we are seeing in Ukraine at the moment. And of course, Ukraine has had a dramatic impact on just about everything everywhere, and I'll come back to that in a moment. Against the background of all of these dramatic events just in the last 24 months has been ongoing issues of climate change, a warming planet, and the effect that has on humanity and also on investments going forward. And certainly the development of ESG, which I think at its roots had issues relating to climate change as its mainstay issue, perhaps now expanded to cover issues relating to Russian investments as well, remains a paramount focus for fund managers into the future. So for goodness sake, what a number of issues to deal with. Now, for him on your screen, that's in the good old days, I might add, just after he was elected as inaugurated as President of the United States. And the US economy, by and large, has done relatively well, certainly historically and through the pandemic itself. Look, when you've got deep pockets, everyone, you've got deep pockets, you can afford to disperse assistance grants and checks to your citizenry to boost consumer spending. And that certainly has helped the US consumer navigate the pandemic crisis years of 2020 and into 2021. The US economy now has performed better than her competitor peers in the EU and in Japan. It's an economy, of course, that is mutating and changing as we speak. And that US economy has certainly recovered. The number of jobless in the United States has fallen dramatically. And this does underpin, in a sense, the strength of the US economy, even in very volatile positions right now. But you know, it's not just that. What we certainly have seen over the course of the last 2 years has been the onset of inflation, in part exacerbated by quantitative easing. Now, inflation is not just a feature of many of the other post-COVID aspects that I'll mention, but quantitative easing and the creation of money into and pumping money into the system certainly has raised prices as well. When you add to that post-COVID supply chain bottleneck that established itself as a result of increasing demand in the post-COVID period, competing with the closure of factories, the demand for supplies as the world came back on stream, all added to increasing inflation bottlenecks. And we've seen that inflation price increase before the Ukraine invasion and increase substantively before Ukraine. So really what we were looking at before the Russian invasion of the Ukraine was a scene set, an initial stage of what has become a much more advanced and much more problematic global environment. I think that it's very true to say that American consumer sentiment that had been relatively buoyant during those worst pandemic years as a result of the checks that Americans got from their central government, that consumer sentiment looking somewhat testy as we stand here this morning. And that, of course, doesn't bode well ultimately for President Biden, who now has to, of course, lead his own Democratic Party into US midterm elections in November of this year. You don't want to be the president at a time of the highest inflation rates in 40 years. You don't necessarily want to be the president when supply chain issues continue to push up prices. And certainly I think this can affect the ability of the Democrats to retain control over the House of the Reps and the House and the Senate as well, come November of this year. So the American political system, as a result of these economic challenges that are now being felt in the United States, is certainly, I think, going to be also a driver of volatility, certainly over the balance of President Biden's term. He could very well be a lame duck president if the Democrats lose both houses. And this sets in motion a further, I think, potential destabilization of certainly the American political system going forward. Now, you don't really need me to tell you about the dramatic effects that the Russian invasion of Ukraine has had on the world. And look, let's be honest about it. Russia's invasion comes from a country, Russia, that has the world's largest supply of nuclear warheads, the world's largest supply of nuclear warheads. Russia spans 11 time zones, one of the world's most important economies from a commodity exporting point of view. And when you think about the geopolitics of this, the location of Russia, the importance of Russia in the global food and commodity, gas and oil export system, you get a sense of the deep impact that this invasion is having currently on the world and is likely to have on the world for the foreseeable future. And this cartoon, I think, sort of represents quite well what Russia perhaps saw as the initial features of her invasion of Ukraine, a relatively easy victory over President Zelensky. But indeed, as we've seen this invasion progress and get bogged down, I might add, certainly in the west of the Ukraine, we've seen the NATO countries unite in a fashion that we haven't seen for some time in the world. And that unity of NATO, the sanctions that have been imposed on Russia, Russia is now the most sanctioned country in the world just over the last 5 weeks. Quite remarkable when you think of the rapidity of events just over the last few weeks. This really does show that we are in for a longer-term conflict, and a conflict indeed that can turn into potentially a Cold War 2.0, as it is referred to. And it's entirely possible that if we reach what's called a frozen conflict, in which hostilities end in Ukraine, but territory becomes disputed over time, and there are a number of regions of the world where this occurs, we are going to enter this period of a fragmentation of the world, what's called in political science terms a bifurcation of the world. It's that Cold War 2.0. It's the West and other allies versus Russia, and perhaps Russia might have other allies as well in this. And this sets in motion a whole new set of global relations and new costs to doing business as well. And yeah, I know it's not so easy to see sitting at home this particular chart, but just for a second, have a look at the intertwining effects of this Ukraine war currently ongoing. Look at all the different aspects of the global economy that have been affected as a result of this. From the issue of food prices, and I'll come back to that in a moment, to the production of oil and the dissemination of oil and gas, to the potential of energy prices across the world to spike, causing substantial inflation for everyone across the world, for the gold price, for interest rates going forward. Every single aspect of the global business and financial system has been substantively affected. This ultimately, what we are seeing, is not a transitory event. This is a transformational event for us in the world. And I think it's quite dramatic, and I am being dramatic, because you see this playing itself out in every aspect of business and finance and every aspect of the advice that you are going to have to give to your clients. Doesn't need me to tell you that there's rising uncertainty, but we can measure uncertainty. The IMF certainly measure uncertainty in a graphical form. And again, you can just see the red line to the right of your screen indicating that spike in global uncertainty, and I suspect that spike is going to remain sustained for some time to come. So what a unique and unfortunate set of circumstances that we find ourselves in. There's a trifecta of volatility at the moment in the world and in the marketplace as well. We are seeing the Fed tightening that began because of that post-COVID rise in inflationary pressure in the United States become a much more substantive Fed tightening going forward. We're seeing geopolitical tensions, of course, with the Russia invasion, and we're seeing a fairly volatile stock market, although the declines have been relatively moderate. But don't get too complacent on that particular issue. 3 substantive issues all coming together at once in the world. A lot of the issues relating to inflation, of course, relate to the domino effect of the reduction in supplies of oil and gas coming out of Russia. And we are seeing Western Europe now trying desperately to wean herself off those supplies from Russia. Germany just announcing in the last 24 hours that she would not be taking further Russian oil by the end of this year or into next year. I mean, that's a remarkable change for Germany that had become quite reliant upon Russian commodity and energy supplies. So commodities have seen wild swings over the course of the last month or so. And inflation that was there because of those supply chain issues, because of quantitative easing in that post-COVID period, inflation now across most of the Western world and in other parts reaching 30, 40-year highs. 30, 40-year highs. Talk about volatility. Now, inflation, given these big spikes that we've seen, driven by commodity prices, but there are other factors as well, food prices that I'll come to in a moment. Inflation, therefore, expected to remain higher for longer. It's as simple as that, higher for longer. It's very difficult to predict whether we've reached a position of peak inflation at the moment, but I certainly think that one would hope that there will be a softening of the extent of the increase in prices over the next 6 to 9 months. So it is perhaps some sort of peak, but it's an extended peak for all of us for some time. And this really is going to force the US Fed to move beyond what could have been 3 or 4 interest rate hikes predicted by economists right at the beginning of this year to what could very well now be the magnificent 7, as the chart indicates, 7 interest rate hikes, and some of them could be quite substantive in order to keep inflation in check. So watch out for that, because it applies to every single country of the world, by the way, with the exception of China, where there's been some effort to stimulate their economy. We'll come back to that in a moment. But every other country in the world is seeing this increase in interest rates, the cost of money increasing and increasing substantively as well. So again, the chart says it all, everyone. GDP growth rates are likely, therefore, that's the red line, likely to soften. And of course, consumer price inflation rising as we speak. And just in the course of the last week or so, we've seen a fairly dramatic, and I have to say, quite sort of stark warning from the International Monetary Fund revising down their global growth projections. Now, it doesn't matter where you are in the world, more or less. Global growth is expected to drop by at least 1 percentage point, or over, it's about a 25% drop in GDP, from about just over 4% globally to just over 3%. So the Ukraine-Russia war is cutting a quarter. It's cutting a quarter of world GDP off the charts. The advanced economies, of course, are going to feel it. Commodity importing countries are going to feel it. But commodity exporting countries are going to feel it less. So as it happens, if you're in South Africa, possibly we may be shielded from the worst of this, but we're not going to get out of the inflation issue, by the way. But I think we're going to be shielded from the worst of it. And if you're in the Gulf region, where oil exports are going to be sought after as a result of sanctions on Russia, you're going to feel less of this pressure going forward. Nevertheless, every country is going to feel a drop in GDP. And go around the world and go and look at the regions of the world, you'll see US GDP last year hit about 5.7% as we had that bounce effect after COVID. This year down to 3.7% and projected into 2023 of just 2.3%. So US growth over the course of the next year is going to be relatively low. Euro growth as well for the next year, projected to be just 2.3%. But what's interesting about that chart, and it's the new projections from the IMF, just have a look at sub-Saharan Africa there on that chart. Yes, GDP growth is going to be affected, of course, but not quite as dramatically affected as those other regions of the world. In fact, sub-Saharan Africa likely to be somewhat better off in general than just about everyone else, except for the developing Asian market going forward. So there's a little bit of light at the end of the tunnel, so to speak, for being in a region of the world that's far away from the Ukraine conflict and also has the benefit to export commodities into a world market that will be clamoring for alternative supplies going forward. But I do think that we're in for a fairly sustained period where the advanced economies are still going to outshine emerging markets and less developed economies as well. So the investor action, by and large, is still going to be very much in advanced economies in selected products. Now, I think, too, that we're going to be affected by, the notion of stagflation. That's increasing inflation and lowering growth. Again, you don't have to be a genius to understand that this will have a dampening effect, by and large, on domestic demand and domestic consumption across the world. And I think the question now being asked by many analysts is whether this all means that we are going to move into some sort of recessionary territory. Can a recession ultimately be avoided? It's not a fait accompli at all. What we have seen in the world over the course of the last number of years, the last decade or two, is that the world is less reliant on oil. We've moved substantially in the world, not enough, to green energy. And as a result, that impact of those very high oil prices is going to be offset by those changes in the way we operate as a planet. So it may be that we can stave off a recession. Goldman Sachs suggests that there is a 30 to 40% chance of a global recession. I don't know better than Goldman Sachs, and I would agree that there's less than a 50% chance of a global recession going forward. But what is true is that fund managers across the world are less optimistic about global growth for all the good reasons that I have showed you. But that doesn't mean to say that there are opportunities. And playing those opportunities is what's absolutely critical. And what you need to do is you need to go back in history and look to see how sectors have evolved during previous recessions. Because it's clear from the research that sectors take a particular approach 6 months before a recession. They take a particular approach and result 6 months after a recession ends. And it is, in a sense, possible to look at critical sectors, themes, stocks going forward that will withstand the worst of what we're seeing at the moment. And that, of course, demands prudent financial management and outstanding product development as well. And that's why you are here this morning. But as an analyst, I'll cover myself. Of course, I'll cover myself by telling you that there could be any number of different scenarios when it comes to how the Russia-Ukraine conflict plays itself out on equity valuations over the course of the next 6 months. If this conflict worsens, if there is a Russian attack on a NATO country for that matter, or even on armaments being supplied by NATO, well, all gloves are off. If there is a frozen conflict, if there is a temporary ceasefire or a settlement or a division of Ukraine between West and East, as there is in other parts of the world, like Cyprus for that matter, then we will probably see some sort of recovery in equity prices going forward. But the jury is really out on the extent of this conflict. What we can say is that many countries of the world are going to have increasing cost structures. In Western Europe, there's going to be more spending on defense. And in Western Europe and in other parts of the world, there's going to be more spending on renewable energy as the world tries to rid itself of the dependence on fossil fuels, particularly on Russian fossil fuels as well. Now, Russia is the world's second biggest crude exporter. So you can see the disruption that that causes to the market. And the disruption is not just in a critical commodity like crude. The disruption is in the foodstuffs that many parts of this world rely upon. For wheat exports, both Russia and the Ukraine combined export 25% of the world's wheat. 25% of the world's wheat. Imagine the disruption to the wheat fields in the Ukraine and the sanctions on Russia as a result. Now, when you look at this particular issue, I must tell you, and you look particularly at this chart, which is the chart of the fertilizer price. And again, large portions of this, the fertilizer production comes from Russia. About 15% of the world's fertilizer comes from Russia. You can see the fundamental basis of our food supply really pushing up the various input costs involved. Now, the political dynamics of this are absolutely clear. We've seen before in the world, when prices go up, this creates social instability in many parts of the world, particularly those countries that are heavily reliant upon imports from Russia. And I think about North Africa in particular. The Arab Spring started, by and large, yes, it was a reaction against authoritarian governments, but it was also a reaction against rising prices, the rising prices of basic foodstuffs. So we have to flag that issue as part of the volatility going forward. And again, just about every chart that I can show you points to an increase in various foodstuffs. That's the world global food price there on the right. And you can see vegetable oils, cereal, dairy, and sugar all going up in price. The only commodity going down in price, by the way, is rice. We might all have to be on a diet of rice going forward. So this is a world that's changed. It was changing before the Russian-Ukraine invasion. It was a world in which the supply side of goods and products had become scarcer as a result of logistical challenges. Now the supply of these critical commodities have become even more scarcer as a result of sanctions and the war in the Ukraine. Flag this all and put it in your in-tray, because this is all going to add to pressures on the world, alongside rising debt levels, particularly in emerging market countries of the world who've had to borrow more and more over the course of the last 2 years to cover the pandemic itself. Now, it's not just about the United States where there are issues. Quickly across to China. For China too, it's a softer landing for their economy. It's no longer growing at 10, 9, 8, 7% GDP per annum. Fantasy stuff for us in South Africa, by the way. But China now is growing at about 4.85% expected over the next few years. Now, not bad growth for a country of 1.4 billion people, but nowhere near what it was a few years ago. And there are additional short-term issues in China that will also impact the supply side and also impact possible inflationary tendencies in the world. Nothing to do with Ukraine. COVID continues to be an issue in Shanghai and other major cities of the world as well. And we've seen Chinese GDP figures look relatively stable, but industrial output is down and retail sales are down in China as well. And I expect this to be factored into the next GDP figures coming out of that country. Now, it's not just the issue of COVID. It's also issues relating to the regulatory environment in China, which has been very difficult as the Chinese government have tried to rein in aspects, particularly of their tech industry. And we've seen a certain skittishness amongst investors to invest in China. In fact, there are large capital outflows from China, which has affected their market as well. So the complexity of this global story, sort of the double whammies of COVID and of Ukraine, has been sort of exacerbated by internal Chinese tensions as well. And I'm not even in this presentation going to mention the possibility of a future world in which new axes form and new power blocks form, which very well could be an issue if China decides to extend her control over Taiwan. And it's not just about President Putin, and it's not just about President Xi. We are also looking in a world at which more populist, more conservative or right-wing political figures are gaining in prominence and gaining in ascendancy as well. So, he might have a worried look on his face. We all will have a worried look on our face wherever we are located on this planet. Now, finally, something about South Africa. Where does South Africa fit in? Well, for goodness sake, those global macro issues play on all of us. But there are domestic political issues as well, which have clearly made the first term for President Ramaphosa extremely difficult. Now, talk about risk across the world and volatility. When you are the president of the ANC, do you know about volatility? Sure, you know about volatility and risk. It's been a tough first few years, and for whatever we might say about President Ramaphosa, he has had to battle. He's had to battle the patronage networks that exist, and he's had to battle the fact that these two very powerful individuals, broadly speaking within the ANC, now find themselves in a spot of legal bother. And their power has diminished, but there's a fight back, as we know, from that in process. So for President Ramaphosa, the key domestic consideration, politically, not economically, politically, is his own political party and the stability of the ANC itself. If you're looking for volatility, look no further than ANC branch meetings. Look no further than the infighting and factionalism and fragmentation that exists within the ANC, and that's going to be a feature of the ANC perhaps for the next few years. Don't expect that to go away. And as the South African citizenry become more frustrated with the inability of government to govern properly, we are likely to see extra parliamentary or extra outside of the formal political environment actors and players begin to rear their heads, as we've seen with the anti-immigration movement now very prevalent in many parts of this country. Politically, therefore, it remains risky and volatile. From an economic perspective, South Africa is likely to see, growth rates this year at about 2%, perhaps a bit below that, but let's say 2% or so. And the projected growth rates for the next few years, very, very low indeed, under 2%. Look, we're not in recession in South Africa, and the fact that we have at least a commodity base to our economy has helped us to withstand some of the worst of what there is. But of course, it's not such an elephant in the room, it's right there. The issue of moving from a state of disaster, out of a state of disaster, into, again, a new batch of load shedding and power blackouts absolutely undermines the ability of this economy to grow much above the 2% level. Still, We are likely to see a commodity windfall continue for a little bit longer. It helped us in the budget of February. The fact that commodity prices have remained higher for longer will help us over the next year as well. But the critical risk factors to South Africa, which are social risk factors, that in particular of unemployment and the effect that that has on our psyche and on our ability to govern smoothly, remains a critical unresolved issue. Yes, we're going to face inflation. We've seen inflation creep up towards just under 6% or so. We've seen the South African Reserve Bank begin a tightening cycle here in this country as well, and we can simply expect those interest rate increases as well. I mean, we don't need interest rate increases. This is a negative for a country that needs to absolutely encourage business and expand business. So we're being affected by those global issues just as much as anybody else as well, and we come from a more vulnerable position anyway. What's helped us in the last short while has been the relative strength of the rand, because there's been capital inflows into South Africa, but the volatility of the rand remains pretty strong. So for those who predicted a very strong rand for a longer period, watch out, because we've seen that rand come back substantively just in the last 2 days or so. The rand is a function of various issues that I've spoken about, but various issues that affect emerging markets obviously affect us here in South Africa. This is a chart from Standard & Poor's, and it's just worth mentioning some of these checklist points to see how these affect South Africa. Heightening geopolitical tensions that I've spoken about. Of course it affects South Africa because of inflation. Monetary tightening occurring in the United States, of course, affects South Africa, as we, in a sense, are also forced to raise our interest rates to be an attractive destination for yield-seeking investors in South Africa. Inflationary pressures, of course, everywhere. The prevalence of COVID-19 continues to be an issue, of course, and climate change issues, of course, affect us, and we've seen that just in the case of the last week with the flooding in KwaZulu-Natal. So all of those checklist issues for emerging markets absolutely affect us, and the insulation that we think we may have to some degree can be very, very limited as well. Finally, therefore, we are moving as a country towards a very major political event that in itself can create instability, the ANC's elective conference at the end of the year. And the key question is whether the President, Ramaphosa, who has a reform agenda, a stop-start reform agenda, can he maintain his grip on power within the ANC, while at the same time holding his party together and shifting the policy environment within South Africa. 3 very difficult issues going forward. For the ANC, it's a tough few years. It's very possible, and this is a projection for 2024, that the ANC will dip to potentially below 50% of the national vote, creating a new political environment for us in South Africa. Now, I think for President Ramaphosa, he is likely to win re-election at the end of the year, and he might well win re-election with a stronger mandate that he had. It doesn't take much because he had a razor-thin majority back at the end of 2017. But that doesn't mean to say that his party is going to be particularly stronger. And it could very well be that the ANC remains a combustible, fragmented organization, even with a Ramaphosa who feels a little bit more secure. Now, in South Africa, of course, we know the challenges, but the challenges remain tremendous opportunities. When the failure of government to deliver is there for all of us to see when the lights go out, well, this is the opportunity for business, for the private sector, together with the state, to move in. And that's where your profit and your business opportunities are, in renewables, in logistics, in the Transnet sector. Government have to come to the party and cut red tape and create an enabling environment, but the opportunity always is there. And the same opportunities exist even in the global sense. The big themes of investment, thematic investments, are not necessarily changing as a result of all of these dramatic issues that I've spoken about. The big themes of renewables, of urban mobility, of the greening of our cities, of infrastructure, this is all going to be a feature of the world, whether there's a Ukraine settlement or not. So again, one shouldn't be too despondent because the opportunities remain absolutely there. It's a case, therefore, of proceeding with caution, everybody, and I think you don't need me to tell you that, proceeding with caution, and it is certainly not a time to take the eye off the ball. It's a time, ultimately, to get the solid advice and to innovate in terms of product and product offering to your clients in particular. And that, no doubt, is why you are here this morning. Thanks very much for listening to me.
Thank you so much, Daniel. Fascinating as always. It's interesting you talked about fertilizer. Actually, I was on holiday last week in George, and I stayed at a dairy farm, and the farmer there was telling me that just 6 months ago he was paying 5,000 Rand for a ton of fertilizer, and now he's paying 27,000 Rand for a ton of fertilizer. It really is astonishing at how much the world has changed in the last 6 months. Thank you so much for your insight. Very, very valuable. Leigh, I speak to advisors all the time, as you know, and I know you do as well. And one thing they're always talking to me about is the time pressure that they're under in terms of trying to deliver great, insightful, and consistent advice to their clients, trying to help them achieve their goals and their dreams. But obviously, with the ongoing burden of complexity and regulation and compliance, their time is being squeezed really quite a lot more than it ever used to be. And then I listen to Daniel and I hear the increasing volatility, the risk and uncertainty we've got. It seems to me that there's never been really a more pertinent time for advisors to partner with an investment expert who can help them deliver efficiencies in their business, but also a wonderful client value proposition as well. And perhaps that's really what you should talk to us about today. Thank you.
Thanks so much, Georgina. And wow, it's so exciting to be here, to be launching the INN8 Invest DFM. And what a tough act to follow after Daniel. That is an amazing discussion around volatility and what's happening in the world. And I mean, just a few years ago, these black swan events, they were rare. We saw them, we dealt with them, but the black swans are flocking, right? And we've seen more and more of these deep drawdown events. It becomes really difficult to navigate from an investment perspective. Never before, right? And I'm saying this, never before has there been such a deep-seated need for focused investment advice for our clients. And that's where the INN8 DFM comes into place. We'll chat a little bit about the DFM, the proposition, and how it helps to navigate these uncertainties of the world, and in partnership with you, the advisor, as part of the proposition. So before we speak about that, let's have a look at really what's going on in the DFM world in the UK and in South Africa, just to give some context. So the story starts, like many stories, in the UK, where we've seen the platform market growing substantially, and this has really been driven by the need of advisors for transparency and efficient technology, and we've seen the use of platforms in the UK transform the industry. There's also a very, very clear separation between advice on the one hand and investments. The advisor value proposition in the UK has completely changed, right? It's moved from fund picking and portfolio construction to more focused financial advice, behavioral coaching, and outcomes. So the world changing there. We've seen a movement towards these centralized investment propositions. So advisors starting to understand that they need to segment their books, understand their practice, understand the levels of profitability in their practice, and really focus on unique solutions for each of those portions of their practices and their clients. And then, of course, the regulatory pressure. And that has really been driven by this compliance and investment risk requirement of financial advisors. In fact, what has happened over the last few years in the UK is that more than 88% of advised assets have moved into model portfolios managed by DFMs. That's around $2.5 trillion rand that's moved into model portfolios modeled by discretionary fund managers. That's almost the size of South Africa's entire unit trust industry. So that has really shaped the UK market. We've seen a large influx of DFMs, around, let's say, more than 110 DFMs dominating that market are the larger players such as Bruins, Rathbones, Quilter, and really transforming the investment environment in the UK. Very similarly in South Africa, right? We've seen the same pressures, the same dynamics, and the same outcomes. We've seen the DFM market grow quite substantially over the last few years, and we've got a number of around 220 billion at the moment, but the latest figure should show something closer to around 280, 300 billion in assets under management. The clear difference, however, between what's happening in the UK and what's happening in South Africa is that many advisors still believe that fund picking is part of the value proposition. And just dealing with the RDR investment papers over the last few years, there are a couple of clear sort of insights coming out there, right? Firstly, that the regulator really expects this clear separation between investment management and advice, right? The regulator's not saying that, Mr. Advisor, you cannot select funds. But what they are saying is that if you are going to select funds, please make sure that you have a due diligence process in place. And a due diligence, unfortunately, is not going to an asset manager roadshow. A due diligence is kicking the tires many hours with asset managers and actually having a process for selecting one fund over the other. And there are thousands of funds in South Africa and tens of thousands of funds, obviously, globally. So that process is really difficult and requires focused, dedicated investment specialists to do that generally on the behalf of advisors. And let's say for a moment that fund picking and the due diligence process is something that an advisor is able to demonstrate. The regulator then says, if you can select funds, the next step is portfolio construction. Show us how you are able to repeatedly and demonstrate your process of selecting, not only selecting funds, but blending funds to secure a certain outcome for the client. And this becomes quite a difficult task for anyone, let alone, the broader financial advisor industry. And that's why the DFM industry in South Africa has become one of the leading trends in the investment landscape. And the reason for this is pretty clear, right? Firstly, is that a good DFM, is able to reduce that advice risk that sits in the advisor's office through taking care of the investment capability within that office. Secondly, it definitely reduces inefficiencies. Thirdly, it takes care of that massive complexity of funds in the market. And fourthly, good DFMs, right? As opposed to the broader asset management industry really plays quite tightly with the financial advisor and understands the problems that the clients face, understands that in a client journey, it's not only sort of one outcome that's able to solve everything, that clearly understand that a client has different journeys. There's the retirement savings journey, there's the retirement income journey, and those two journeys require different attention. And DFMs who understand that and able to help advisors navigate through that environment are really doing well. All right. So that's sort of what has happened in the DFM landscape in South Africa. So when thinking about the INN8 Invest DFM proposition, we really need to be clear around what makes us different, right? And in this presentation, we'll be speaking about three aspects: about our investment pedigree, the fact that we've been around for 2 decades managing money over various market cycles with a broad and deep and experienced investment team. Secondly, it's about the power, i.e. the scale that we have to use to be able to negotiate with the larger asset management industry and bring all those efficiencies and scale to the financial advisor, and then arguably most importantly, the partnerships that we have not only within our broader group and externally, but with you, the financial advisor. All right, so let's chat. Let's start with pedigree. So, I mean, as mentioned, we've been around since 1999. That's 2 decades of managing money. Now, many people have said to me, you know what, Leigh, the investment proposition of a DFM is generally sort of, quite, maybe homogenous, maybe not a differentiator. And I would have said, a couple of years ago that that's true. However, with the influx of new DFMs into SA, it's become very clear that our capability, the experience, the fact that we've been managing money for more than 2 decades with an actual established track record, with a 20-plus investment team, with our funds that have been, in the 100% of our funds actually over the first and second quartiles over the last 5 years, the fact that we are able to cover the full range of South African unit trusts, and the offshore mutual funds, that we have teams focused and dedicated that on a continuous basis, really sets the investment proposition apart. And that we have grown from an assets perspective. The 350 billion rands assets under management, which includes the services that we provide to large financial institutions to focus and help them through approved fund lists, etc. And we really believe that our institutional knowledge, expertise, and track record sets us apart relative to our peers in the industry. And this is a picture that I really love, right? It really shows and showcases the talent. We've got some no hairs, some grey hairs, some youngsters coming through, a great blend of investment professional, all focused on the DFM, all focused to make sure that the DFM's investment proposition is best in market. We've got some household names. In fact, before I get to the names, this is over 423 years of investment experience in this team. Now, we've got guys like Joe Frasco, Malcolm Holmes, Ken Grobler, who've been in the industry between 20 and 30 years. We've got our head of manager research, Jenny Henry. Not only is she the head of our manager research team, she's also the president of CFA South Africa. So high quality individuals focused on the DFM, focused on the outcomes of the solutions. And something that I've come across in the industry as well is the question around, how do you build portfolios? Well, we build portfolios fit for purpose. We have the skill and breadth of capability to build multi-asset portfolios for certain environments, specialist building block portfolios for certain environments, relative portfolios or absolute return portfolios. The skill set is broad enough to be able to build in any way, depending on the mandate of the client, the benchmarks required, and the time horizons of the client. And that's what we're really good at, sitting and understanding what is required by a financial advisor and tailoring our portfolio construction process to suit those needs. And then something that I really, really enjoy speaking about and really ties into what Daniel has said. The world has changed, right? And when we all learned about portfolio construction and how to build portfolios, the concept of diversification, is pretty, most of us understand that, at its almost lowest level, diversification between asset classes, so bonds and equities and cash and properties and blending those, and then maybe a second level of diversification, speaking to geographic diversification. We've seen what's happening in the world today. So, the ability to be able to externalize assets and understand what's happening globally, incorporate that into the investment portfolio is crucial. But the world has moved on from a portfolio construction perspective. One has to increase your level of diversification, and that's where DFMs, multi-managers have come into play, and that's what we call sort of manager diversification, the ability to blend different styles, different philosophies, different teams who view the world differently. And it's crucial to understand this, that every asset management company and team views the world differently. Therefore, not one asset manager will get their decisions correct 100% of the time. And when you select a manager, there's a few things you're going to have to think about, right? You have to think about not only in terms of the actual house, but what are the equity capabilities? What are the fixed income capabilities? What are the asset allocation capabilities? And what are the offshore capabilities? All those factors need to be taken into account when building a portfolio. And the world has changed where no longer can you select a few large balanced funds and think you're going to be able to navigate the complexities and volatility of the world. One needs to be very specific around the types of mandates, the types of managers you include, the skill sets that you include in portfolios, and why, right? And we term this concept within INN8 Invest enhanced diversification, and we separate between these the local portfolio construction methodology as well as global. So we believe that one should be able to include boutique asset managers, those managers who are quite flexible, quite nimble in the decision making. You have to be flexible and nimble in the environment that Daniel spoke about. You need to be able to see the opportunities for what they are, be able to sell out, buy in quite quickly. That combined with core large managers, you'll find as a staple in our portfolios. And then we use flexible mandates. Now, flexible mandates are a very interesting mandate. It's the one mandate where you find a performance profile, and particularly among boutique managers, which we call an asymmetrical performance profile. That is, when the managers are able to use the full extent of their mandate and actually have the capabilities to do so, to capture a lot of the upside when markets are running, but also most importantly, to protect capital when markets fall. So it's this asymmetry that becomes quite important in the mandates and the flexible mandates that we create. And yes, we do use increased active management, particularly in environments of volatility. You need your managers to be able to take the best opportunities out there. While we do incorporate passive to get that, maybe some beta exposure, our mandates our solutions include mostly active. In the global space, again, a really fascinating space to construct portfolios. There are so many good managers out there, but you have to have the team and the breadth of the team to be able to see the wood for the trees. So the way we construct portfolios in the global space is incorporating these large global giants like BlackRock, Bailey Gifford, and the likes, and blend them with we call them gems. And these are the mandates that we as a DFM have access to that is not available in the broader market, really niche opportunities out there. And we end that off with combining that with what we call South African stars. And these are who we believe are the best South African managers managing money globally, whether that is the in-house capability or whether there's a partnership with larger offshore managers. So the enhanced diversification, our approach to dealing with the complexity of the market is it increases the probability of achieving investment outcomes. So as you diversify, as you increase that level of diversification and then enhance it, just increases the probability of achieving the investment returns and helps navigate uncertain markets with a lot more flexibility. Right? So that's the pedigree side of our proposition. Next, we speak to power. So when we speak about power, we think about three main sort of pillars. It's the scale and to access the best fees in the industry. As an institutional player with decades of institutional expertise and the asset base that goes with it, it gives us the ability to be able to access funds and fund classes that are not necessarily available in the retail space. And we make that available via our solutions within the model portfolios. And you know what, 2 years ago, 3 years ago, something that maybe was was something less important, but the importance of the balance sheet, the importance of the knowledge that the client has and that the advisor has, that we will be around in the next 20 years. We are part of a larger group. We are a sustainable business, that volatile external threats or even mistakes in trading, and trading mistakes happen, won't sink the business. The business is large enough to be able to carry through very difficult times. And that's the importance of having a large established group balance sheet. It gives that comfort to clients while still having the independent DFM that focuses on portfolio construction. And then lastly, about technology and investments, and that's the ability to invest continually in the best technology within the business, but not only within the business, but to also create and develop technology and deploy that technology into your business. And we'll see some of that a little bit later. And I love this picture. It's simple, but it describes exactly what it is that we do. It's our institutional backend. It's the investment team with decades of experience, focused on portfolio construction, focused on you and your practice, with the operational rigor and process and compliance, and add to that the reporting capability, which we'll chat about a little bit later, is co-branded and customized, adding that institutional backend and being the engine behind the investment engine behind the advisor practice. Right? We truly believe that the advisor owns the relationship with the client, and the DFM proposition that we're putting forward to you does not displace that. It's not a threat to your relationship with the advisor. In fact, it enhances your value proposition to the advisor because we become your investment team. Right, then lastly, partnerships. And partnerships in many ways are really what we are all about, right? And we see partnerships again in three ways. It's the group partnership, and we spoke about that earlier, where we have access to local asset class information, global asset class information. We've got access to banking expertise. We have access to life expertise, understanding what advisors within groups go through. And we really bring all of that into our proposition. And it's really crucial to understand that the INN8 Invest proposition was developed with advisor input. We asked advisors, what is it that you want out of the DFM, and how do you want us to partner with you? And the proposition we're putting forward really is a culmination of advisor insights and really there to support you as an investment or an advice practitioner. So those group partnerships. And then secondly, we have a partnership with BNP Paribas Fund House, and for our global manager research specifically. And that gives us access to about 500 investment analysts focusing on global research out there. So a great partnership to have that really extends our footprint globally. And then most importantly, it's the partnership with you, the financial advisor. And if we really had to look at the benefits of INN8 Invest for you, is that we incorporate your voice as part of the portfolio management process. Now, there are many different propositions out there, and I've seen them all. And there are DFM propositions that really it's a product. You buy it and you give it on to your client, and that's it. Your voice is not included, your inputs are not included. What we have done as part of our proposition is to make sure that your voice from the time we launch your portfolios through the portfolio management process is included in the portfolio management process. You'll have a dedicated portfolio manager and a dedicated business development manager with you to support that, to ensure that the portfolios are unique and uniquely designed for the needs of your practice as a unique financial advisor. And we also co-brand, and this is great, right? So co-branding really gives that feel of ownership. You have your own set of fact sheets, your own quarterly reports, your own thought leadership, and which I'll introduce a little bit later, even your own online environment where you store all your collateral that is co-branded. And then there's customization, which we spoke about a little bit earlier, customizing portfolios, understanding that there are nuances, respecting the fact that you do have views as a financial advisor. Of course, we will challenge, and of course, there will be rigorous debates in the final portfolios, but never ignoring that you as a planner have been in the market and respecting that and making sure that your voice is included. And while we're taking care of the investment component for you, it gives you time to grow your business, find new clients, reduces costs, so in fact improves overall profitability levels, and then obviously aligns with the regulatory requirements to reduce your advice risk. So here's a nice video.
We become the advisor's partner by placing wealth managers and their clients at the heart of everything we do. INN8 Invest, our DFM, provides you with the investment edge your clients expect and deserve to empower your practices and drive business efficiencies, freeing up your time to do what you do best, advise clients. Advisors partnered with INN8 Invest have access to a DFM advisor portal, a single-touch, seamless and comprehensive web application to keep you up to date with everything you need to know about your model portfolios and underlying funds, as well as other expert DFM information, such as market updates, investment insights, and other value-added content. You have secure access to the portal via your email address and two-factor authentication. Check for important updates and view total AUM for your firm. Articles, webinars, videos, and other engaging and insightful resources are also housed on the portal. Gain sight of valuable information about each of your model portfolios, generate insightful client-ready reports, explore interactive and customizable performance graphs, experiment and analyze with simulation tools, as well as browse the latest model portfolio fact sheet, underlying fund fact sheets, investor reports, and fund notes. Stay compliant, effortlessly and efficiently with our digital client mandates. The mandate is securely stored on the hub and is as legally binding as the outdated wet signature on a hard copy document. At INN8 Invest, our quest is to continuously improve and stay ahead of the curve, providing our advisor partners with the tools they really need. The DFM Advisor Portal will continue to evolve, with functionality additions to enhance an advisor's practice and expand their investment knowledge.
So I'm really, really excited about the INN8 Invest Advisor Portfolio. Definitely a unique tool and part of our proposition that really differentiates us in the marketplace. So the Advisor Portal, as mentioned in the video, really looks at you as an advisor in a holistic manner. So not only will it include a content hub that stores all of your content, and remember that content is co-branded, the environment will be co-branded for you, but it also, and these releases will happen over the next few months. It will include investment tools to compare and contrast to model portfolios, to other funds, to different benchmarks. It will have advisor tools available to you to help you with that, the challenges of understanding and creating the right blend of portfolios, or even which portfolio to select for the retirement savings journey, and even more importantly sometimes, understanding the levels of income, the type of portfolios required for that decumulation journey or retirement income or living annuity journey for your clients. So those advisor tools will be available quite soon. And then, one of the, and this is what we've seen through many engagements and many interactions with advisors over the years, is that one of the most challenging and onerous parts of the practice is that quarterly statement, especially when you have client portfolios across different platforms. And by the way, we also manage portfolios across all platforms in South Africa. is that the consolidation of those statements on a quarterly basis into one advisor statement, and you sort of push it onto the client. What we will introduce in the advisor portal is a consolidated investment statement function, taking the assets of your clients across all platforms, clicking one button, all your emails and PDFs for client statements will be ready for you and your clients, and you'll send that off, taking almost 2 weeks of time away from what you usually spend on, your team usually spends on, to actually focusing on what you do best, is growing that business, giving advice. So look out for the tools that we'll start delivering into the advisor portal over the next few months, but it is available. The Content Hub is there, and when you sign up, you'll have direct access to that. All right, and now the DFM multiplier. And I think it's quite evident what we're trying to achieve through our proposition. A DFM cannot simply just be about creating model portfolios. It has to be about creating value for the advisor, creating value for the client, and creating value for the overall system. And that's what we've really dug deep into understanding, and we call this our DFM multiplier, adding value to the client, to your practice, and to your overall quality of your advice. And please, in order to understand this, the actual concept, we've actually got a nice video, but I'll attempt to explain it here, is that we've understood that you really get 3 alphas out there, specifically within the space that we work with. It's about our requirement to deliver investment alpha, right? So that's net of fee above benchmark performance over time. And then with the partnership with the INN8 DFM to actually unlocking your practice alpha, and that's the ability to focus on your clients, reduce overall costs within your practice, and then with that, giving you more time to focus on you and your client relationships. And those 3 aspects unlocks around 2.5% of value over time. And we'll be releasing a white paper so you can delve a little bit deeper into that. But really, over time, that 2.5% compounded adds massive value to the entire system. So to understand the concept of DFM multiplier a little bit better, here's a little video.
This is Sam. Sam has built his advisory practice over the last 20 years. He is passionate about the process of helping each and every client, no matter their standing, attitude or age, to plot a roadmap to financial independence and freedom. He walks the extra mile as a trusted partner. In the last few years, however, Sam is becoming increasingly frustrated as the available hours to spend with his clients, to fully understanding their needs and offering bespoke advice and financial coaching, seem to be getting less and less. Sam and the wealth planners who have joined his practice are struggling to provide the level of client service and interaction that was the core focus of their business. The team faces volatile markets that demand focused and engaged investment management attention. On top of this, regulatory evolution demands real value addition from advisors to clients, which Sam is happy to offer and welcomes for the benefit of his clients. Clients are demanding investment expertise and high-quality, well-researched funds to create the bespoke and tailor-made solutions that they deserve. There simply isn't enough time. Sam's team currently manages to spend only half of their available time with clients. The rest is gobbled up by administration, investment management, and training and development. This means more than a third of their time is spent on efforts that could be handled efficiently by means other than direct advisor involvement. By finding the right partner that can truly make a difference, Sam has taken the decision to partner with a discretionary fund manager. His team needs a partner that will give their clients the greatest opportunity at achieving the outcomes that they are aiming for, the investment alpha that is required. His practice will benefit from a strategic partnership that can improve efficiencies in his operations, freeing up hours that can be reinvested to future-proof the business, in essence, giving Sam practice alpha. With these alphas in place, his clients will benefit from this partnership as Sam will have more time to enhance the quality advice he already provides, adding additional advisor alpha. INN8 Invest is the DFM that groups all the alphas in one room by offering Sam and his team the DFM multiplier effect. We are part of the INN8 team, an independent financial services provider that supports the wealth manager of the future. When Sam partners with us, not only will we deliver investment alpha for his clients, we will unlock practice alpha and enhance his advisor alpha as well. That is the DFM multiplier effect, the key that unlocks the potential in your practice.
And that's it, the DFM multiplier effect. A wonderful concept and something that, take your time. You'll be releasing a white paper to work through it and really understand how a DFM and how this DFM adds value to you and your practice. So besides the investment team, we also have a support team, right? The team that will be out there really helping you with your day-to-day requirements around investing, practice. And this team is led by Wasim, who unfortunately couldn't be here today, but really high caliber of investment professionals there to support you. And I mean, as part of the value proposition, every advisor that signs up with us will have their own dedicated portfolio manager as part of your solution as well. And that portfolio management team I introduced a little bit earlier. And then, something really that is important to me is to show the depth and strength of our product and operations team. Investment management does not work without a strong and dedicated team to ensure that compliance, the trading, that everything runs smoothly on the back end, to ensure that the experience of the portfolio managers, the clients and advisors is a really, really good one. And we've got a team of this is the highest qualified operations team I've ever been part of. Led by Tyron Harrison, the COO of the business, and many of our ops professionals are CA qualified. Right, so ladies and gentlemen, this was the launch of INN8 Invest DFM. This is what a DFM should be doing for you. Bringing that pedigree, power, and partnerships together with you and forging better outcomes for both your client and your investment practice. And to sign out, our value promise is future-focused and engaged investing. Thank you, and contact us anytime to discuss how we can be your partner of choice. Thanks.
Thank you very much, Leigh. Really great to see you out there and getting that out in the market. Thank you. And as I predicted at the start, we've had a few questions in. The first ones I'd like to explore are for you, Daniel, if that's okay. And the first question coming in is from Nico. He thought he'd get his money's worth today. Hello, Nico. You've put 3 questions in one. Should the petrodollar be replaced by gold or yuan? And what will the effect be on the US dollar? On the US dollar and US equity markets, and how will the rand be affected, and assumingly the effects on our markets?
Well, thank you for a very extensive question, of which I don't have all the answers, to be perfectly honest, and the investment team will need to get onto that. I think that there's been a lot of speculation for many years about the issue of the US dollar being the predominant currency of value in the world. And the Ukraine-Russia war has been seen by many observers as a precursor to this new world order that could diminish the value of the US dollar, and in the process, new financial systems will be introduced in parallel, perhaps by Russia and China together, perhaps led by China in the medium to longer term. Clearly, if that's the case, there is likely to be a devaluation of the US dollar in the longer term. But I have to say that for the moment, I expect the US dollar to remain relatively buoyant. And in fact, I think the US dollar will remain buoyant because of the interest rate cycle increases coming out of the US Fed. So I don't see this question, which I think is is an interesting question to really postulate about the future. I don't think it's something that is going to affect us immediately. But you can come back in 5 years' time, and we could be looking at this particular month of February into March as the scene setter for what could be a fairly dramatic global change on all of those issues that the questioner has raised. But for the moment, I suspect we are still going to be largely playing in US dollar valuations. The US markets, to me, remain relatively well valued, and the underlying strength of US markets remain relatively good despite the volatility that we've seen. I think there's legs in the US market still going forward. So I'm not going to give the questioner the benefit of being that dramatic about the changes that are coming, but we should flag this unique period in global history and see, frankly, events unfolding.
Thank you, Daniel. So I've got another question here again for you, Daniel. This is coming from Peter. Will South Africa be negatively affected as a result of her ambiguity on criticism of Russia and the Ukraine conflict?
It's a very good question. I think there is going to be pressure on South Africa. I think it's already being felt. There was a recent telephonic discussion between President Ramaphosa and President Biden, and you can pretty much expect the US president to have told President Ramaphosa that the US's intentions to isolate Russia are quite substantial. And over time, the question really is, will the US become some sort of global policeman as to how other countries in the world apply the sanctions that have been introduced? Now, we don't quite know to what extent the US is going to demand that kind of acquiescence from many other countries of the world, particularly non-aligned countries like South Africa. But if the US does put pressure on South Africa, this clearly can have an impact. Not just an impact in terms of how South Africa acts in terms of a foreign policy, but also within the ANC, because we know within the ANC there are competing visions, there are competing ideological strands, and there are competing factions that view Russia as an ally. Others might view Russia as a contravener of human rights. So I think that this will play itself out within South Africa. But when South Africa, a country, we are really crying out for foreign direct investment. And we don't just need foreign direct investment from developing countries and from emerging powers. We need FDI from the Western world as well. And if we are serious about looking for FDI, we have to play, I think, a much more prudent game in terms of how we deal with the Russian position. And that means distancing ourselves from some of the abuses that certainly are occurring as we speak.
Oh, to be a fly on the wall when that conversation took place, for sure. And finally, for you, Daniel, which regions of the world are most at risk, and which might be better placed to withstand this level of geopolitical volatility?
Well, Jenny, look, I mean, I've alluded to the fact that, I do think that, commodity exporting countries are the ones that are going to be insulated to a somewhat better degree. So certainly for the African continent in particular, those countries that have particularly oil and natural gas exports, could see their bacon saved, I suppose, as a result of that. We are seeing deals just in the last 24 hours struck between Angola and Italy in terms of the supply of, I think it's oil supplies or natural gas supplies. Now, it's quite difficult for Africa. Nigeria has tremendous natural gas supplies. Quite difficult logistically, suddenly, to provide the necessary infrastructure to provide this to Europe in particular. But I think this does bode better for many African economies. So I do think, and I buy into, broadly speaking, the fact that the African investment story can remain relatively buoyant. My one caveat on that is certainly on the issue of debt and the debt that's been mounting up in African and emerging economies in particular. So, I'm an analyst, and I'm always going to say on the one hand this and on the one hand that, and I protect myself entirely when I speak. But that's so, from the African point of view, and I still also think that many of the Gulf countries as well, the Gulf countries, not North Africa, we always sort of Gulf, Middle East and North Africa together as an investment region. North Africa to me is almost quite separate. The Gulf countries with strong oil exporting potential still, I think, are going to be relatively insulated, even though some of the input costs as a result of the food price increases are going to affect their domestic economy. So those are the two regions. But certainly the US, I think, will continue to withstand the worst of it thanks to relative self-sufficiency in terms of their own domestic oil supply and a relatively strong domestic economy still.
Thank you so much, Daniel. Very insightful as always. Leigh, moving over to you. This question has come in. I should think it may well be from one of my team, but let's see. Leigh, you recently wrote an article and spoke about consolidation in the DFM space. Can you elaborate a little bit more on that one?
Yeah, thanks. Thanks, George. I mean, it's quite a tough topic to speak about, because obviously when consolidation happens, there are the winners and I suppose the losers in that space, right? And what we've seen is that South Africa is not the biggest market out there, right? So we've seen 110 DFM businesses in the UK. And already between 40 to 60, the jury's out there around the number of DFMs in South Africa, in SA, right? That's a lot of competing DFMs in the business. And the asset pool, the advised asset pool, is only so big. And what I see playing out into the future is, as these the DFMs, the smaller DFMs particularly, will reach a point in which the asset growth will plateau. And asset size in the DFM space is really important. And the reason it's really important is because that asset size, the total asset size you use to negotiate with asset management and to ensure that you get the best sort of institutional fees over time. And you also use your size and scale to be able to invest in technologies. Tech is changing every day, right? To invest in technology for advisors, to invest in technology for your own practice. And that level of investment is going to become higher and higher over time. So profitability and sustainability of DFM businesses going forward is going to be is questionable. Particularly DFMs with smaller asset sizes, and I do believe that over time you'll find some consolidation happening. And today, George, if you look at some of the official and unofficial numbers, the top 6 DFMs in the country, they manage in about 80 to 85% of all assets. So that asset consolidation is already starting to happen.
Yeah, and I think it's really important for advisors to be asking themselves, as I think you're alluding to, what is the person I'm partnering with, whether it's a platform or a DFM, are they going to be around in 3, 5, 10, 20 years' time? Am I going to have that consistency of partnership, which I think is probably, a lot of what you're alluding to there as well.
Absolutely crucial statement. When you partner with anybody, never mind the partner that looks after the investment component of your book, you want to ensure that your partner is going to be there tomorrow. And scale, being part of a larger group, the largest financial institution in the country, in Africa, being part of that group, really increases that probability that we'll be around for a while.
Absolutely.
Yeah.
Leigh, well, that actually leads me really nicely into the next question, which is a little bit of an elephant in the room. So let's just address it. Let's label it and address it. You speak of independence, and yet you are part of a big group. How independent are you really?
Yeah, and that's also an important question. Independence must be understood clearly. We hear the statement independence being thrown out sort of quite a lot in the market. And when it comes to independence, the most important part of independence for a DFM or any investment business is the independence of the investment process, the philosophy, the team, and investment governance. If that is all in place, that is the important part of independence. And our investment process is fully independent with no outside influence at all. And then, yes, we are part of a broader group, and we leverage those the benefits of being a part of a broader group to enhance the value proposition for advisors and clients.
Thanks, Leigh. And finally, last question. You mentioned about, being quite difficult to select funds, and I think Daniel's also, explained that very well with his presentation. And we keep hearing about it not being as simple as it used to be, and that regulation speaks to certain requirements.
Yeah.
What is that? What are those requirements?
Yeah, I mean, I mentioned it a little bit earlier in my chat, and so RDR, we've been hearing about it quite a bit in SA. But we've seen how it's played out in the UK, right, George? I mean, you've been quite close to that.
Yeah.
And while so what's happening, and if you look at the investment papers, there's a clear separation that the regulator wants to see between advice, so the Cat 1 license, and investment management, the Cat 2 license, right? And that the functions and responsibilities that each of those licenses are required to fulfill are done within those licenses. Now, in that, the regulator is not saying that an advisor can't select funds. The regulator is saying, look, if you don't have a partner to help you with this, you're going to have to demonstrate your capability of selecting funds out there. Now, I've spent over also a 20-year tenure in the industry. I've spent numerous amounts of hours, probably years of hours, with asset managers doing due diligence, understanding, a good asset manager versus someone that's not as good, and being able to select the best, being able to contrast different styles and blend them in portfolios. Now, an advisor who selects their own funds needs to be able to do that and demonstrate how they've done that. And once if they can do that, they need to demonstrate the portfolio construction process that is repeatable, that it's across the board, that all of their clients are experiencing the same process. And unfortunately, a Cat 1 license doesn't give you that capability to ensure that your full client base experiences the same investment expertise, where the Cat 2, through various mechanisms like model portfolios or unit trust funds, does actually provide that.
Thanks, Leigh. I mean, it's a perfect opportunity for me to plug some of our previous webinars that I hosted with Jen Anderson, where we talked about, the changing landscape that RDR was bringing, in particular towards that Cat 2 license. So please do look on the INN8 Connect section of our website, and you'll find access to those webinars. That brings us really nicely to a close. Gentlemen, thank you very much for your time. Thank you very much for your energy and the insights that you've given to our audience. And, ladies and gentlemen, if you've liked what you've heard today, please do get in touch with Leigh and his team. And I'm sure you'll be very happy to help.
Absolutely.
Thank you very much. Do stay tuned to your email and various LinkedIn channels. There are more webinars coming up. There's one in May that I'm hosting with the brilliant David Pullen about how to build your brand and tell your story in the market. Please do stay tuned for that. But now it's time to say goodbye from our first face-to-face environment webinar. Thank you very much, gentlemen.
Thanks, George.